I'm Philip Clark, Farmers Weekly's Economics and World Editor. 3 months ago, I had a look at the global beef market, and at that time, things were looking pretty bullish, if you pardon the pun, with supplies from Brazil still struggling in the wake of that country's foot and mouth problems, Argentinian production held back by government policy, and beef output in the USA and Australia constrained by ongoing droughts. The only question mark back in the autumn was what would be the impact of the global recession on consumption. But even then, the prospects were encouraging, with demand holding up quite well in the key emerging economies of China and Southeast Asia, providing further support for prices. Well, things can change quickly in commodity markets, and 3 months later, there are signs that the global recession is biting deeper than expected. This first became apparent in September, when Russian importers started cancelling their orders as they realised that they had paid too much for their beef. Cargoes started piling up in St. Petersburg, and distressed sellers were left struggling to find alternative outlets. Many incurred a loss on their consignments, and it was then that traders realised that the recession was for real. The view now is that beef consumption is going to take a real hit in 2009, primarily as consumers the world over start trading down to cheaper cuts of meat, but also because they'll be eating less of it as they switch to cheaper alternatives. Analysis by Geneva-based consultants JERA suggests that demand for beef will drop by 1% this year, with particular falls recorded in North Africa, the Middle East, Russia and Argentina. And this situation would be worse still were it not for the fact that the Chinese have developed a real taste for beef, and consumption there will continue to grow. Against this background, JERA believes prices will come under pressure in 2009. For example, it has predicted that EU beef prices will drop by about 8% this year to about €3,000 a tonne. But there is one saving grace, and that is that beef supplies are still expected to stay tight, and this will underpin the market, limiting the extent of any price falls. Brazil, in particular, will see the number of slaughter cattle shrink as producers respond to last year's higher prices and engage in herd rebuilding. It's a similar story in Argentina and Uruguay. Australian beef production is also struggling to recover from years of drought, which has damaged pastures and undermined the grass-fed sector. Beef production is set to fall again in 2009, though there could be a slight increase in carcass weights as the country's feedlots are replenished. The same applies in North America, where the high price of feed grains in 2007 and the first half of 2008 wreaked havoc on feedlot margins. These are now starting to recover as lower grain costs filter through, but the USA is set to remain a major net importer of beef, despite some recovery in its sales to Japan and South Korea. Overall then, JERA anticipates that the world supply of beef will drop another 400,000 tonnes in 2009, and global trade will also shrink. Take a look at the red arrows on the trade map, which point to reduced shipments from the likes of Australia, Argentina and Brazil. This will help limit the drop in beef prices resulting from the global recession. There is one other important factor, and that is currency. Most of world beef trade is conducted in US dollars, and as the dollar strengthens, so any price falls will become more muted when converted back into national currencies. Closer to home, UK beef producers are already seeing this currency benefit, as the weaker sterling against the US dollar and euro boosts export earnings. This is one reason Finnish steers have been pushing towards the £3 a kilo mark since Christmas. Combine this with potentially lower feed costs, and the British beef sector looks like being fairly well protected from the worst ravages of the global recession.